Hello, everyone, and welcome to another episode of Founders Grid, sponsored by Gaper.io. Today we have James. James is the founder and CEO of Fifth Line Capital. James, welcome to the show.
Yeah, thanks for having me.
So, give us a brief background about yourself, what you've been up to prior to Fifth Line Capital.
Yeah, so I had actually started a business when I was in college. It was a small e-commerce business, ran out of my college apartment. Ended up being fortunate enough to be able to sell it for a small profit when I graduated. It was a good experience. I then decided to take my money and start getting involved in the stock market. My education was in finance, so I figured that made the most sense. I got really bored of looking at a stock ticker screen for 10 to 12 hours a day by myself. So I pulled my money out and I started getting involved with a couple of early stage startup companies, primarily in a kind of hands-on advisory role where what I would do is I would get involved on an equity basis, work to develop out more of a business side infrastructure of the company, get them to a place where they could raise some angel funding. And then as the funding would come in, I would essentially rotate my shares out and liquidate them, and that's how I would receive compensation. So, that's how the original business model started. Full disclosure, I did have a quote unquote real job for about 2 days selling mortgages before I decided it really wasn't a fit. I decided then and there I need to do something more independently on my own. So that's when I started getting involved with advising with the startups. That's sort of how the business model developed initially. I always knew I wanted to, work with startup companies and build and grow something. I realized it took a lot of capital and I did not have, the right capital pool at the time. So that's how I was able to start working with some of the early stage companies. And that's how our business model initially developed. So, a few years ago, we started, more of a fee for service advisory model, focusing primarily on angel and, some pre-seed stage companies where they'd raised some money, but they were still in the earliest stages. And we primarily focused on outsourced CFO and other financial services to the companies for a fee.
Okay.
So one of our companies that we're working with very shortly after we got engaged got to the point where they were raising a Series A. And along with their Series A, they raised this thing called venture debt, which I had no idea what it was and, how it worked. So what we ended up doing was, building out a model to help them raise the capital, and they had worked with an advisory group to help them raise the capital. So what we saw was this was an opportunity for us to get involved and offer this as a real service to companies at a much later stage. So that was, between 2.5, 3 years ago. We actually ended up shedding the other business model offerings. So the other fee for service offerings, we stopped the advisory business model and started focusing, full time on, advising growth stage companies on sourcing and structuring various forms of venture debt financing. So that was our focus through a good chunk of 2018 and 2019. And then our plan, going into 2020 was to really develop out more of a direct equity investing model using our own capital. And that was our plan going into 2020. We had made our first investment in late 2019, and we had a couple more lined up for Q1 of 2020.
Yeah.
And that leads us to, the COVID pandemic.
So, interesting Q2 and Q3 of 2020. Apparently, the whole world has gone through its own learning curve. So when it comes down to the startup space in March, April, May, I remember there was a lot of articles going on, or even the VCs, the venture capital, were rethinking their investment thesis, right? So they're like, okay, which space to evolve? The LPs were putting pressure on them. Telehealth was certainly springing up. But now I believe the world is going back to normal, especially the startup ecosystem is going back to normal. And if you look at September numbers, things are going back. So what are your thoughts? How, and especially when it comes down to how the thought process has evolved in the last 6 months?
Yeah, so it is interesting, and we're fortunate enough to really deal with both companies at various stages, everything from privately held startups with no outside funding to companies that have top tier VCs and have raised, hundreds of millions of dollars as clients. And we also, so from that, we're able to get a good sense of how the equity investors at a much later stage than what we're able to look at, how they're putting their capital out, putting their LPs money to work. And also on the venture debt side of things, how lenders are looking at it. It's all very different mindsets. I think what happened in March and April was everyone thought it was 2008 and 2009 all over again. They thought the global economy was going to come to a complete standstill. Everyone was going to be defaulting, but I think what people learned very quickly, primarily the funding sources, whether that's equity or debt. And I'm not talking about banks. I mean, private lenders. Everyone has records amount of cash still that they raised over the past few years. Luckily, lenders and investors, they make money when their money goes out to companies. They can't make, so they're more motivated to put their money out. Yes, for a couple months, we saw everyone really kind of pull back, focus on their portfolio, see how things were playing out. But what we've seen is over the past several months is, companies figure out how to streamline costs. So having, 30% of your headcount not doing anything, just on a bench on an as needed basis isn't necessary. Burning ridiculously, counting on capital coming in from investors isn't really the goal anymore. So companies have been able to streamline their costs while still hitting their growth metrics. And then funding sources, they realize they need to put capital out to, put it to work. Luckily, things like PPP and other government funding sources have been able to help companies stay afloat. There are certain areas, hospitality is still pretty out of favor with a lot of investors and lenders. I'd say lenders more so. Equity investors for companies that have proven out that there's a real market need, and this is truly a once in a century event that has nothing to do with a poor business model or lack of need. It's just something that happened that was unforeseeable, but it's still a valid company. We have companies that they went from doing 12 million a year, all in recurring revenue, to top hotels and restaurant chains to zero, just because they said, look, we're not making money, we can't pay you. Company went to zero, but their equity investors know, okay, 12 to 18 months from now, we're going to be able to get back to where we were. We're here for you. So we've seen cash really start to flow. And I think that, in all honesty, is what's going to keep the startup ecosystem not only afloat, but flourishing, because as the funding sources sit on these mountains of cash, they put it out. The companies, as a result, are able to keep growing. Their customer base, getting money from their funding sources, continue to purchase their products and services and so on. And it really keeps things moving. It's not the standstill that I think a lot of investors and companies and really just everyone thought was going to happen when you saw the market crashing in March and April.
So now, which brings me to another question, pre-COVID world, when it came down to, yes, the remote work was increasing, but it wasn't the top priority. And I know multiple founders personally who were having a challenge if they were from different geographical locations, right? The VCs used to be like, especially the coastal VCs, either the East Coast or the West Coast, they used to be like, no, the co-founder, the CTO needs to be within 20 kilometers or within 30 minutes of drive or within 1 hour of drive, right? But now, because of this, many the co-founders, they've kind of like, some of the people have just gone back to their home countries, in Latin America or Eastern Europe, right? So do you think the shift towards from the VC's perspective, from the investor perspective, will they become more and more receptive towards having global founders?
So as in how, these investors will view having a founding team spread across the globe? Is that the question?
Yeah.
So I think they're going to view it a lot more favorably than they did before. I'm a big believer, and there's no replacing a face-to-face meeting or face-to-face collaboration. It does need to happen. I think, 100% remote work across the board, and from now on, I think it can stifle some progress in some ways. However, I think at the same time, a lot of investors can see it as a way to tap into a diverse talent pool. We've had these tools like Zoom for, however long we've had them, these different collaboration tools, but now they've become essential. People are really, they found ways to make them part of their infrastructure within their workforce. So I think it's a good way, you're seeing these big companies like Google and Facebook saying they want 50% plus of their workforce fully remote forever. Now, instead of having to focus on the talent pool in cities like San Francisco, where, yes, there's a great talent pool, but there's also a good talent pool in Kansas City, Missouri, and Chicago, Illinois, and Austin, Texas. And it allows companies to tap into these talent pools that otherwise weren't available to them for whatever reason. And that's everything from a big company like Facebook to a small startup where, right now, for example, some of the, employees that we're looking at bringing on are based across the country, and before that wasn't really a thought for us. When you talk about, remote work being, in the workplace, but not, as common as it obviously is now and will be. That was supposed to be one of our perks that we were looking at when we were hiring new people in 2020. We had a plan to bring on 10 to 15 new employees through this year, and we've been fully remote since we started. We travel quite a bit. It's been great. And that was actually going to be one of our big perks to differentiate us from different companies recruiting the same talent. Now we got to get a little bit more creative because it's not so much a perk anymore. But yeah, and I do think that to an extent, this office spaces will be required to some extent. I have friends that, unless you live in a very large house with a very designated, very well built out home office, people want to get back to work. People are naturally social creatures. And I do think there will be, much more of a hybrid model between in-person and, remote work going forward.
Yeah. Interesting. So last question, when it comes down to 3 pieces of advice that you would give to young entrepreneurs who are starting out, and especially the ones that started out during COVID and are stuck in the stage of raising their first seed, pre-seed round. So what piece of advice would you give?
So just to kind of confirm the stage. So it's a company that probably has some revenue, somewhat of a proven or an MVP or proven market, but they really haven't hit that inflection point for growth yet. Or are we talking like they want to start a business right now?
No, the ones that have already started, they have figured out the end. Yep.
So the biggest thing is be persistent. Like I said, funding sources need to put money out. They're not going to stop like everyone expected. So be persistent, be creative in how you're getting a hold of these guys. It's reaching out through email, LinkedIn, things like that. That's, more common at this point because you're not going to bump into people at a conference anymore. You're not going to be able to track down someone, in person at this point. So various forms of virtually connecting with someone is very useful. I think for company, if you're just starting out, and you're looking at raising your $1 to $3 million round to really grow, and you had expenses built in on, around that, look at how you can cut those expenses. I think one thing we've seen across the board are companies are realizing the aggressive burn model, which was falling out of favor over the past couple of years, is really out of favor now. Burning and raising is not a valid business model anymore. Be frugal with your spending, spend what you need, have capital and reserves, and be ready to, capitalize on various growth opportunities that cost money, but you don't need to be burning $1 million a month like we see some companies have done, and some are still doing. So I would say those are 2 pieces of advice. I guess a third piece is understand that this is a temporary situation. COVID is not going to be a forever thing. People adapt. I think we've seen that people are already adapting quite a bit. Restaurants are back opening in a lot of the country. People are adapting their lifestyle. People are adapting their work style. And, the biggest thing is, if your business model was built around something that, it may not be a need anymore, but your product still has value, figure out how you can adapt. Figure out how you can pivot. Maybe your similar customer base, isn't there anymore in the same way. How can you still add value using what you developed to a similar customer base or a new customer base? Just because something that you might have started, didn't really work out because of a once in a lifetime event, it doesn't necessarily mean that's, your product and there wasn't a fit. It just means that things have changed, and the good products and good founders figure out how to adapt.
True. James, thank you so much for being on the show.
Thanks for having me.
It was great having you. I'm pretty sure we could have talked for another 20 minutes, but my marketing team tells me I need to keep it within 15.
No problem. Yeah, I appreciate the time.
Thank you so much.